Oh, yes.
Jason Bible. Get the answer to your question that's keeping you from taking action and succeeding today.
Sure. Test 1 2 1 2.
Get ready. The guy that will put your fears behind you is on the air now. Taking calls at 713-785-1817. Toll free 877-881-0271. Now here's your host, Jason Bible.
Hot mics.
Welcome to the show. Welcome to the show, Jason Bible, Right Path Real Estate. I'm in the studio all by myself today. And I want to take on something that is turning into conventional wisdom that is absolutely wrong. I want to be, I don't want to pull any punches here. I just want to tell you just right on the onset that I've heard this for the last, let's say 3 months. And it's absolutely incorrect. It's not, this isn't a, we have a lot of differences of opinion. You guys, if y'all listen to this radio station, if you go to other real estate events, if you talk to other real estate educators and investors, we have a lot of varied opinions. And there's not a whole lot of times where I say, no, that doesn't work, that's wrong, that's insane, don't do that. There are some times I do say that, but by and large, we all have some disagreements on the way we invest. For example, we do owner finance, but we don't do a whole lot of it. I'm still not a big fan of owner finance for a number of reasons. I won't get into that on the show. I like wholesaling. I like flipping because I enjoy the income, but I really like buy and hold rental properties. And there's different ways to buy these things. I also like to lend in real estate, so there's different ways to lend in real estate. And I don't necessarily agree with all the different ways that people manage or implement their goals or implement things in their business to reach their goals. I may not agree with them, but that doesn't mean that they're wrong. This, I'm going to tell you, is 100% wrong. And let me tell you how this all started. So yesterday, I had a long day at the office. So Tuesday, I brought my oldest son, Cameron, into the office. He's 10. And yesterday, I brought my youngest son in the office, Carson. He's 6. So what I'm doing with the boys, my wife and I call them the dudes. What we're doing with the dudes is we bring them up to the office just so they can kind of be around office stuff. And then what's important for the kids under 8, 9 years old, we do something called Pleased to Meet Yous. So in the morning, boys got to get dressed. They got to wear a collared shirt. Although they end up wearing jeans and a collared shirt. I'm looking for a blue blazer for the boys, but we can't find one. Anyway, so we get them kind of dressed up, very casual, but get them dressed up for work. Then we bring them up here, and then we do Pleased to Meet Yous. And what Pleased to Meet Yous are is networking. We're teaching them how to be professional networkers, professional business people. So what they have to do is they have to let's say they find somebody in the office, and they have to look them in the eye, and they have to put their hand out, and they have to say, my name is Cameron Bible, pleased to meet you. What is your name? And so that gets them used to doing that. Cameron is really good at it now that he's 10. Carson is getting a lot better at it. He's 6. And so that's really the intent. And for them to listen to what Dad does at work all day. I don't force real estate down their throat. So I'm just letting them listen to it so they get kind of accustomed to it. And then Cameron and I actually went to lunch Tuesday, and I'm trying to raise some money from him to do a deal with his mom. So that's a whole different discussion. So yesterday I have Carson in the office. Went to a couple of great meetings, had some great lunch meetings with a couple of guys, and get back here to the office. And then we had another meeting that kind of went haywire, and we got so much other stuff going on. So I jump in the truck. I take Carson home. Got home a little early because it's hard to keep a 6-year-old in, on a 12, 14-hour workday. So my wife turns on one of our favorite local talk radio shows. And I really like the show. The guy's a good dude that's on the show. And he starts talking about the economy and the market. That's actually the theme of today's show, the economy and the market. And he starts talking about how his money manager, the guy that manages his money, was explaining to him what's going on in the market, why we haven't seen rapid inflation, all this other sort of stuff. And normally he does a really good show. When I was listening to this show, he couldn't have been more wrong. Now, I'm not going to name who it is because that's not really important. All I want to do is I want to go after the idea that was being broadcast on his show. Well, this morning I checked Facebook, and there's a gentleman that posted a couple of days ago. He says, good leadership decisions and good leaders always drive markets, companies, and economies. Dow at 25,075, NASDAQ at 7,000. And I posted, actually it says 15 hours ago, so I posted yesterday, these numbers have nothing to do with good decisions at those companies. And then his response is, well, Donald Trump making some good decisions, and that's why the economy is, quote, booming. And so that's when I thought today we really need to get at this idea that the economy is doing well, because all the indicators I see do not say that. And I'm going to give you some empirical data during this radio broadcast today. First, let me say this. The economy and the market. When people say the market, what they really mean is, where's the Dow at today? They think the Dow is kind of like or the S&P. You see that kind of people interchange Dow and S&P. No one really talks about the NASDAQ anymore, but that's a whole separate discussion. It's the S&P or the Dow. The market is doing good, ergo, the economy is doing well. And those two things are mutually exclusive. Let me say that again. The market and the economy are mutually exclusive. Now, do they have some impact on one another? Absolutely. But what happens on one doesn't necessarily translate to what's happening on the other. It's just absolutely not true. The Dow could go to 9,000 tomorrow, and that doesn't mean that the economy is in shambles. The S&P could go to 20 million tomorrow. It doesn't mean the economy is doing well. What you've got to understand is the market is a means to discover the price of a company that's listed on that exchange. That's all the market is when we talk about the capital markets. That's all that means. Doesn't mean the economy is doing good. It means none of that has anything to do with it. It just means that this is the price in which someone is willing to buy or sell the financial asset that is that company. One of the things I always find hilarious is whenever you read these reports about derivatives exposure and how derivatives are terrible. Oh my gosh, that's all a stock is. A stock is really just a derivative. It derives its value from the company. But it really doesn't. Truth be told, we're going to get into this as the show unfolds. Truth be told, the value of that piece of stock doesn't have anything to do with the underlying company. All that went out the window in 2008. I'll never forget, I was in business school. So I'm doing my MBA at night over at this great little private school here in Houston Baptist University. And I was taking all the finance classes. I did an MBA. I spent most of my time in finance. And I'll never forget when they teach you modern portfolio theory and efficient markets, and then you start to get into valuation tools. And I always found it hilarious. In 2000, I was in business. I was in the program between 2007 and I graduated in December of 2009. And I can remember sitting down figuring out, well, what's the what is a company really worth? And there's a couple ways to do valuation methods, but really how you get down to what a company is worth is you figure out what its free cash flow is. In other words, how much cash does it produce? You will occasionally hear economists say this: how much surplus cash does it produce? Which really translates to this great term, profit. Let's just call it cash for a moment. And what you're willing to pay for that cash determines what your return is. Tom talks about this in as it relates to cap rates, and I like how he describes it. He describes it as, like, let's say a machine shop. If a machine shop kicks off $1 million in cash, in net cash profit a year, what are you willing to pay for that machine shop to capture $1 million? Now, if you're new to the show, I get it. This is Right Path Real Estate. We're talking about real estate. We'll get to real estate in a minute, but it's important we cover this stuff because it all relates to real estate, and it really relates to real estate and why you should be in real estate and not a whole lot of other stuff. I'll get to that here in a minute. We got a machine shop, kicks off $1 million in cash. What are you willing to pay to make $1 million? Would you pay $1 million for a business that makes $1 million a year? I can tell you, absolutely. That's 100% rate of return. I'll do that any day and twice on Sunday. Would you be willing to pay $5 million for a business that kicks off $1 million in cash? Absolutely. Absolutely. In fact, right now, businesses, depending on the type of business, its cap rate, if you will, its rate of return is somewhere between, let's say, 5 and 7%. So what does that mean? Well, I'll give you a 10. A 10% rate of return on $1 million
1 minute
is what? $100,000. So if I want to buy a business that's kicking off $1 million in cash, $1 million in profit at a 10% rate, that means I'd actually pay $10 million for that $1 million in cash. It's 10%. We get back from the break, I'm going to talk more about why folks don't understand the difference between the economy and the market and why that's detrimental to their portfolio. It's Jason Bible, Right Path Real Estate.
Mike's off.
Time is money in a real estate deal. If your insurance company is slow or non-responsive...
Mark, you are absolutely right. Discounted cash flow model.
You need a quick turnaround on quotes or binders.
One of my...
that is Benchmark Insurance.
I haven't done the presentation in a while, but
I
ran a... or I found the discounted cash flow model for Snapchat right before it went to IPO, and it's hilarious.
Bundling your properties on a single policy will help save time and money. Benchmark has been in business for over 10 years, and we insure over 30,000 properties. Contact Benchmark about our exclusive investor package. Call us and let us show you what we
Robin.
can do for you at
281-569-4353.
That's 281-569-4353.
You know, Michael, there's a report that comes out every year that shows the relative
281-569-4353.
How do I put this?
At benchmarkbroker.com.
It's a weighted return, if you will. In other words,
you know that there are
how much of the return on the market is attributed to Apple, Facebook, Google, Netflix, Amazon?
Well,
it's only really a handful of companies that are really moving the indices.
At Quest IRA, we offer retirement accounts that can be used to invest in real estate, promissory notes, private entities, and much more. Many of our clients loan money from their IRAs to fund real estate deals all over the country. We don't sell any investments or give advice. However, we do hold free networking events, weekly educational classes, and free consultations with an IRA specialist. For more information, visit our website at questira.com or call us at 1-855-FUN-IRAs. To tap into the $24 trillion in retirement accounts in the U.S., call Quest IRA at 1-855-FUN-IRAs or go to our website, questira.com.
Are you expecting to close accurately, on time, and with lots of communication on your home purchase? You've come to the right place. I'm Jennifer Hernandez, Senior Loan Officer with Legacy Mutual Mortgage. Our goal is to give our borrowers and referral partners an amazing experience during the loan process. My team believes in putting people and culture before results. Our company concentrates on building those teams who operate with structure, process, and recognition for going the extra mile for you. This way, we have the energy to make this your best home purchase ever. Give us a call today to find out the simple steps to get started. I'm Jennifer Hernandez, the Hernandez team at Legacy Mutual Mortgage. Jennifer.legacymutual.com or call 713-579-3611. Again, Jennifer.legacymutual.com. We can't wait to consult with you soon. NMLS 514497.
Equal Housing Opportunity Lender. NMLS 514497.
Are you looking for an investor-friendly general contractor for your investment property? Then call Fast Track Remodeling at 832-742-9992 or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip rehab or a rental rehab, we manage every aspect of a rehab from start to finish with a highly efficient, standardized process.
Over the last 6 years, Fast Track has completed over 700 projects, which has helped us to create our 3 keys to success. Use a detailed scope of work so that everything gets done, train and maintain quality crews so it gets done right, and complete the work in a proper order so it gets done fast.
No more managing it yourself, no more doing the work yourself. Fast Track Remodeling really does manage it all.
So give us a call today at 832-742-9992. Again, that's 832-742-9992, or reach us on the web at fasttrackremodeling.com.
This is Business 1110.
Call Jason at 713-785-1817 and look for us on Facebook Live at facebook.com/RightPathRealEstate.
Hot mics.
Welcome back. Jason Bible, Right Path Real Estate. Today I'm talking about the difference between the economy and the market. And when most people talk about the market, they're talking about something that comes on the news that tells me things are good or things are bad. And the problem is those things don't have anything to do with each other, especially since 2008. We've got record highs on just about everything. Everything. I mean, real estate's at all-time highs, rental rates are at all-time highs, cap rates are at all-time lows, occupancies are at all-time highs. You know, the equity markets are all-time highs. Although I will tell you, this is not investment advice, but I am starting to look at the precious metals market. I do think you should have a little bit of PM, a little precious metals in your portfolio every now and then. And I've been watching silver. Actually, don't tell anybody I've been watching silver. So silver is quite interesting if you could pull a chart up of it. It's good to have some precious metals. Some people say 10% of your net worth or 10% of your portfolio ought to be precious metals. Depending on what your net worth is, it could be pounds and pounds of that stuff. And it's like, where do you store all of it? Anyway, so that's a whole different show. As another tangent, what happened to my Bitcoin bros? I call them my Bit Bros. Where'd my Bit Bros go? All the guys that were promised Lamborghinis and Ferraris and, you know, like all the women and the crazy parties. Like everybody thought they were the next, Wolf of Wall Street on Bitcoins and cryptocurrency. And things got awfully quiet when it went from 20,000 to like 14,000. It hasn't bounced back. What happened there, guys? What happened? Oh, let me think. There was this guy on this real estate radio show that said when the options are when you're able to short sale the future contracts, that Bitcoin's probably going to fall out of favor. Who said that? Oh, that'd be this guy right here. And so a lot of people got crushed, and they totally deserve it. It was great. It is great. The Bitcoin craziness, and I don't know if you guys were getting this in your email box, but there were online marketers marketing through Google AdWords, Bing, Facebook, and they were doing some ad retargeting depending on what websites you hit about how to invest your IRA in Bitcoin. And I thought, wow, is that not the worst advice I've ever heard? Let's take our retirement account that took you 20, 30, 40 years to save. Let's take something that you traded your life, and let's be honest, that's exactly what you did. Something you traded your life for, and invest in something that is one of the most volatile assets on the planet. That sounds like a great idea. In fact, there were articles where people were taking out HELOCs and refinancing their houses to go invest in Bitcoin. If that doesn't scream top peak of the market, craziness, people with no idea what they're doing, I don't know what does. Let's trade. Think about this. Think about the mental gymnastics you've got to go through to do that. Let's trade our home for a made-up currency that is relatively illiquid, meaning it's difficult to sell, that is extraordinarily volatile, that is completely unregulated. And I'm not all for regulations, but there's got to be some regulations as it relates to these exchanges. Because you don't know who's you could sit there, you could be an exchange, and you could monitor the buy and the sell, and then you can run your own proprietary trading desk on the side just based on the orders coming in. I mean, there's some crazy fraud you could do. And I'm sure that's not happening. I'm positive. I mean, the guy that sold the guy that invented Litecoin and sold out all of his holdings, less than 30 days ago, I'm sure he did that on the best of intentions. I mean, because who would want to see an asset that they helped build make them a billionaire? I mean, that's kind of like Steve Jobs, 2 years into Apple going, hey, you know what? I like being CEO, but I don't like owning the stock. So let me just sell all of it. Oh man. Anyways, I love that Bitcoin folks that bought at the peak got slaughtered because they need to. They really need to. A lot of those are actually Asian investors that have pumped up that market. Anyways, let's go back to the stock market and all that. So I'm seeing all these folks that are posting on Facebook, radio personalities, like everybody saying, oh my gosh, Trump is making the economy so much greater. It's so awesome. Nothing could be further from the truth. I would love to give Trump all the kudos for making this economy great. And he absolutely has nothing to do with it. Here's what we know. We know that sovereign governments, central bankers, in some cases large corporates, have injected $200 trillion in cash into the market. $200 trillion since 2008. Where's that money go? Where's that money go? Goes into assets, doesn't it? A little bit of it ends up in Bitcoin. Ends up in housing. A lot of it ends up in higher, more expensive real estate, meaning multifamily apartment complexes, office buildings. That's where that stuff ends up at. You print enough money, it will look like the economy is booming. And that is exactly what's happened the last 10 years. Make no mistake about it. Heck, if Hillary Clinton were in office, everybody would be screaming and yelling about debt. Notice nobody's doing that right now. But that is absolutely what's propping up these markets. Let me give you something from this article. Again, this is the best article out there as it relates to the economy and the markets and what's happened in 2017 and what we think will happen in 2018. And that's Dave Collum's article, the 2017 year in review. His last name is spelled Collum. He's a chemistry prof, full tenured faculty at Cornell. I think he's at Cornell, and he's an investor. And he writes this year in review every year. It's fantastic. It's 200 plus pages. So I'm going to read a couple of excerpts from here. And one of the reasons I like this year in review is obviously as a tenured faculty, he spends a lot of time publishing papers. So when he publishes this, he puts all the references in. So when I read something here, more than likely it's got a reference attached to it, and you can click right on that bad boy and go right to the original article and read it. And that's one of the things that makes his writing so. Plus, it's very easy to understand. Whether you use the arithmetic or geometric mean, both gave us 1.3% annualized growth. Let's spell this out. During the recent era in which markets soared, the economy tracked the Great Depression. I'm going to read that again. I'm going to read it again because there was a lot getting thrown at you, but it's very important you understand this. Whether you use the arithmetic or geometric mean, both gave us 1.3% annualized growth. Let's spell this out. During the recent era in which markets soared, the economy tracked the Great Depression, meaning the growth in the economy is not what's causing the growth in the market.
2 minutes.
Why? Because there's virtually been no growth in the real economy. There has been virtually zero growth. And by virtually zero, I mean 1.3%. Here is what's incredibly scary. Total domestic corporate profits have shown an annualized rate of just 0.1% over the last 5 years. I'm going to read that again. That's real important. And that's what when I was listening to this radio show host yesterday, he didn't get it. He thought all this inflation was because there's all this economic activity. Nothing could be further from the truth. Total domestic corporate profits have grown at an annualized rate of just 0.1%. Guys, there's no growth out there.
1 minute.
There was a joke going on at Zero Hedge a couple of years ago, right after the 08-09 crisis. I've been on Zero Hedge since like the beginning. And I'll tell you, it was so funny. There were all these articles in 2010 about what are called green shoots, and everybody would just... So in other words, one little sector of the economy would be doing really well. The reality is it's not true. You're looking at a 0.1% in domestic corporate profit growth in 5 years. That's horrible. In fact, one could argue they're actually worth less now, just based off inflation. We get back to the break. We're going to talk more about the economy and the market and how real estate is a great place. Jason Bible, Right Path Real Estate.
Mike's off.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group.
Yeah, Richard, it's going to be interesting. That's for sure.
We understand that investors aren't just looking for a number
Thanks,
of
Jeff.
what the property is worth, but a comprehensive analysis of the market.
Ginger, you got a little gold? Ginger, you got a couple of houses. I think that's even better than gold.
Or check us out online at Next Gen.
So there's a guy I'm going to start reading. I
Are you a
listened to
realtor
his
or seller
YouTube
that is
channel.
concerned about the new TRID rules and closing on time? I'm Jennifer Hernandez,
Nikki?
Senior Loan Officer at Legacy
Could you
Mutual
drop out the
Mortgage,
commercials for
and
me?
We have mastered the...
Thanks. So there's a guy I'm going to start reading that his name is Aaron Clary, Captain Capitalism. Now, I'll tell you, if you go to his YouTube channel, it is very raw. Maybe is a good way to put it. There's a lot of what my mom would call potty talk. But the guy is a former senior analyst for a big bank, and he's got a number of books. I didn't know he had written a bunch of books. I just heard about his YouTube channel through a different website. And he's got a book called Poor Richard's Retirement that I think I'm probably just going to order the thing, go ahead and read it. But it's supposed to be very good. And it talks about he was like I said, he was a banker. He was also their head analyst for a while. And he saw lots of people's personal financial statements. He did a lot of work with the bank. He did a lot of it in the middle of the financial crisis. And he's come up with a little formula, if you will, for what you should have, and riskier investments and savings and all that kind of stuff. And it's really interesting. So one of the things he talks about is having about 200 ounces of precious metals. Now, I realize in gold that's a lot of money. I'll just tell you that right now. So he talks about, hey, pay off your debt, get you your savings account set up, have you about 200 ounces of, let's say, like silver, something like that. Then start looking at these other investments. So he is a proponent of real estate. He talks about real estate the way I like to talk about real estate, which is you're going to buy rental properties and you pay those things off, right? You don't re-leverage because the debt and if you run any sensitivity analysis, that's what you find that kills you in the long term. It's the debt. And that's really the point of the show. We're seeing, we've been re-leveraging and leveraging for the last 10 years. And all of that cash ends up somewhere. All that debt ends up somewhere. So in any case, I think that's a book I'm going to start reading here this week. So if you guys are interested in a little bit of the precious metal stuff, I think he talks about that in that book. So, all right, Nikki, you want to turn commercials back on for me?
So give us a call today at 832-742-9992.
We got 1 minute.
Okay.
Taxes. Just the sound of that word makes people cringe. At Anderson Advisors, we provide tax reduction through asset protection for real estate investors throughout the country. Our unique philosophy has CPAs, lawyers, bookkeepers, and estate planners with one common goal, helping you, the real estate investor. Check us out today at AndersonAdvisors.com. And don't forget to tell us you heard about us at Right Path Real Estate.
Are small returns getting in the way of your retirement plans? Why settle for mediocre results? There's a better place to invest. The experts agree, single-family real estate is one of the best investments you can make. Find out how JB Fund Services offers a 9% preferred return and up to a 13% waterfall. Call us today at 281-915-0906 or visit our website, jbfundservices.com. That's 281-915-0906. This investment is offered to accredited investors.
This is Business 11.
Call Jason at 713-785-1817 and look for us on Facebook Live at facebook.com/RightPathRealEstate.
Hot mics.
Welcome back. Jason Bible, Right Path Real Estate. We're talking about the difference between the economy and the market today. Let me go over a couple of these stats again. Total domestic corporate profits have grown at an annualized rate of 0.1% for the last 5 years. That's not great. In fact, a gentleman over at Goldman has said that R&D spending is down 2.5% of GDP from 4.5% and is a drag on the economy. What does that mean? So when companies want to innovate, they do it through R&D. You got to do research and development. And through R&D spending is how you come up with the next product, the next great thing. And R&D as a percent of GDP is down substantially. The economic bellwether General Electric saw revenue drop 12% and earnings fall 50% year over year. Again, I'm reading from David Collum's article, 2017 Year in Review. His last name spelled Collum. It's available anywhere. It's on his website, Peak Prosperity. Meanwhile, corporate America witnessed a 71% rise in business debt since 2008. So what's going on? What's going on with the rise in asset prices, and particularly in the capital markets? Because companies they're not spending money on people. We haven't seen a big increase in labor prices. There's not a big expansion into R&D. Their profits haven't grown but more than 0.1% over the last 5 years. What are they using all this debt for? Oh, they're buying back their stocks. That is exactly what's happening. They're buying back their stocks. Guys, all the stuff that's going on in the market right now, it has nothing to do with the fundamentals of running a business. It's got absolutely nothing to do with it. It's got nothing to do with the tax plan. It's got nothing to do with Trump being in office. It has everything to do with really low rates of borrowing and a whole lot of it. It's the subprime. Like if there's a good analogy, everyone's familiar with subprime housing, right? We were lending money to people, to households that should not have been lent money to. It's that simple to understand. They were not great borrowers. In fact, we knew they weren't great borrowers because we called them subprime borrowers. They're less than the best, less than prime. But we lent to them anyway. I won't get into that whole discussion. That's a whole different discussion, whole different radio show. What we're seeing is subprime borrowers in the capital markets. Subprime companies. Why would you increase your debt 71% when your growth rate is 0.1%? Why would you do that? It doesn't make any sense to me. It really doesn't. I mean, it just, I don't. And then everyone's running around saying the economy's great. There's all this inflation because there's all this, business activity. No, there's not. There's absolutely not. I heard someone say yesterday, there's not much inflation because I don't even want to get into this argument because it doesn't even make sense. But there's not much inflation. Really? There's not much. Have you not seen what the Dow and the S&P have done since 2009? And that has zero to do with corporate profits. It's got zero to do with cash. I mean, if you really run the model, we never regressed below the mean in 2008 and 2009. What does that mean? Markets are the sum of the mean. Let's say that mean is, 1,000 on the S&P. At the median price, 50% are above 1,000, 50% of the time it's below 1,000. We never went through the bottom. We never went through the trough. Markets are a hill and trough system. A valley and, a hill and trough system. They go up, they go down, and that going up and down in between the peak and the valley is the mean. We never went through the mean. Why did we never go through the mean? Real simple. Central bankers got involved and started deploying a massive amount of capital through fiscal and monetary policy. Monetary policy was done through the federal government with the omnibus program and the bailouts and all that other nonsense. And the United States wasn't the only one that did it. It was $200 trillion from all these sovereign entities. $200 trillion. So where does that money end up? Truthfully, it ends up in hard assets, but not so much this time. I mean, the hard assets in commercial real estate. We've seen it happen a lot on the equity market. So we got a lot of people running around claiming they're geniuses in finance when all they're doing is running along with the Fed. One of the first things they tell you when you go to business school, when you get into the finance and investing part of business school, the one rule they'll tell you, don't fight the Fed. What does that mean? I wouldn't want to short a market where the Fed is injecting a massive amount of capital into. In fact, if you all remember, if you go back to 2008, 2009, you couldn't short certain financial stocks, certain car industry stocks. If y'all remember any of that, go back, read those articles. I remember. I'm like, what do you mean you can't short it? This was the problem with Bitcoin. You couldn't short Bitcoin. Then all of a sudden you start shorting Bitcoin. What happens to the price? Uh-oh. What happens is price discovery. Well, can you have price discovery if you've got an entity that can quite literally print ones and zeros? Is price discovery allowed to occur? Absolutely not. It's not a fair market. Government steps in and says, well, no, that's worth $1 million. You say, what? I think it's only worth 100,000. Nope, it's $1 million. I mean, what happened? This is an exaggerated analogy, but it's probably pretty simple. It's simple enough for this discussion. What happens if the Fed comes into Houston, Texas, and says, instead of bailing out banks and homeowners and all that, we're just going to buy 50% of the houses that are available on the market? What is that going to do? That's going to displace 50% of your buyers, and it's going to run the prices up through the roof. The opposite is also true. What happens if 50% of the inventory for the total year comes on the market all at once? We've had the same discussion as it relates to Harvey. What is the impact on Harvey? A little side note here, guys. I was running some numbers on Harvey, and on MLS, and I take some of this data with a grain of salt because not everybody enters their data in right to MLS. Not all agents do this correctly. But there have been about 800 houses that have sold on MLS that were impacted by Hurricane Harvey. 800. Out of my estimate of about 266,000, we haven't even started seeing the great liquidation from Hurricane Harvey. And there will be a great liquidation. Trust me. It's coming. I was chatting with some real estate investors yesterday, sitting at a table with a group of guys. I mean, between all of us, we probably do between their lending companies and their house buying companies and our house buying companies and our coaching clients or our consulting clients in RightPath.
2 minutes.
I mean, sitting at the table, there's easily 600, 700, 800 deals a year, if I were to guess. And we all pretty much agree, like, this thing hasn't even started yet. I mean, we're not even 1% into what's going to happen, what the impact of Hurricane Harvey on this real estate market looks like. We're not even there yet. So when people run around and say, oh my gosh, the market's doing so well because of Trump, that is absolutely incorrect. The availability of cheap credit is distorting the market. Cheap, unlimited credit. It's way too cheap. Now, the question is, Jason, how is this impacting the real estate market?
1 minute.
I'll tell you this right now. I am so glad we're not in any commercial markets. In other words, we're not in commercial real estate because I think it has greatly distorted the commercial market. In fact, I used to use a chart at the weekend retreat. In one particular asset class, multifamily has completely decoupled from all other commercial asset classes, meaning its rate of rise is significantly greater than all other commercial asset classes. And typically, commercial real estate as a group all gains value at the same rate. So now we know where some of that $200 trillion went. We get back from the break, we're going to talk about how this impacts single family. It's Jason Bible, RightPath Real Estate.
Mike's off.
Hi, Clint Coons here, attorney and avid real estate investor. You know the greatest mistake real estate investors make is not understanding the potential.
I'm going to warn you guys,
exists from owning real
if you're going to listen to Aaron Cleary, he is a raw dude.
Specialize in protecting real estate investors in all
so if you're going to read that book, I have not read it yet, but I really want to.
We provide guidance so you pay
but it might be a little saucy. I'm just telling you that now.
We have 100
fair warning.
Employees that range from lawyers to CPAs to estate planners and much more. Download our free ebook, The Invisible Investor Strategy, today at AndersonAdvisors.com or call for a free risk reduction analysis and financial blueprint at 800-706-4741. Anderson Business Advisors will help you keep more of what you earn. Call us today at 800-706-4741 and mention Right Path Real Estate.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group of appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but a comprehensive analysis of the market. Give Next Gen a call at 713-346-9911 or check us out online at nextgenappraisals.com.
Are small returns getting in the way of your retirement plans? Why settle for mediocre results? There's a better place to invest. The experts agree, single-family real estate is one of the best investments you can make. Find out how JB Fund Services offers a 9% preferred return and up to a 13% waterfall. Call us today at 281-915-0906 or visit our website, jbfundservices.com. That's 281-915-0906. This investment is offered to accredited investors.
As a real estate investor, you rely on your property inspector to determine the current condition of the home and your potential return on investment. Principal Inspections was founded by investor Jeremy Humphrey to do just that. Working from the investor's point of view, Principal Inspections will give you turnkey inspections that are high quality, affordable, and focused on information pertinent to investors while not clouding the report with unnecessary details. Founder Jeremy Humphrey comes from a family of real estate investors. He started Principal Inspections for investors because as an investor himself, he experienced the need for fast, quality inspections with information directly pertaining to property condition and potential resale value. Principal Inspections will save you time and money. Call Principal Inspections, 832-684-5516. That's 832-684-5516. Or go online to principalinspections.com. That's principalinspections.com. License number 21264.
Do you have cracks in your brick, doors that stick,
1 minute.
or sheetrock that's coming apart? Then you may have foundation movement. Due to our expansive soils in the Houston area, it's probably not a question of if you have movement, but when. Call Foundation Check for a truly independent, unbiased foundation evaluation. Foundation Check has been in business since 2009 and has completed over 1,400 evaluations. We're not in the business of repairing foundations or selling you unnecessary peer work, but we are in the business of evaluating your foundation. Our product is designed for house flippers, landlords, or even owner-occupied properties. Each of our files is reviewed by a licensed engineer. Remember to check before every repair. Call 346-702-3825. That's 346-702-3825. Or you can reach us online at foundationcheck.com. That's foundationcheck.com.
This is Business 1110.
Call Jason at 713-785-1817 and look for us on Facebook Live at facebook.com/RightPathRealEstate.
Hot mics.
Welcome back, Jason Bible, Right Path Real Estate. Theme of today's show, the market is not the economy and vice versa. What's going on in the market's a completely random craziness. So if you listen to this entire show, I talked about how much money's been injected into the marketplace, the impact it's had on financial assets in real estate, in particular commercial real estate. So now the question is, what's been the impact on single-family real estate? And really, I think the only thing that's keeping single-family real estate from absolutely skyrocketing is the fact that not everybody can get a loan. That's just the reality. And I also think the other part is not everybody has a great paying job. And I can show you the stats on that. I won't go through them today. But the other thing that's really great, if you're going to build a real estate portfolio for income and wealth, I highly recommend rental properties. We're buying more every single day. And one of the reasons I like rentals is you continue to pay debt off as you own that piece of real estate. The real key to real estate, the real key to investing is managing risk. You're managing operational risk. You're managing financing risk, interest rate risk. Here's what I know. Markets like Texas, our market will continue to grow, even if there's a collapse. In fact, if you go back and look, even during the worst economic downturns in Houston, our median home price continued to rise. Now, some neighborhoods got absolutely crushed. Here's what I know about rental properties. The lease rates, the monthly rent, rarely goes down by more than about 10%. So if you've got enough margin in your rental property, you're making a few $100s a month in cash flow. If the market goes to pot, you're going to be just fine.
2 minutes.
It's hard to make those same claims in 2008 and 2009 when some of y'all's 401k turned into a 201k. You had a 50% reduction in the value of your assets that don't produce cash. So we're big fans of single-family real estate around here to build your income and wealth. If you want to learn more about how we build wealth with single-family real estate, you can go to rightpathrealestate.com. That's rightpathrealestate.com. We've got a weekend retreat coming up in a couple of weeks. What is the weekend retreat? We spend an entire weekend explaining the ins and outs of single-family real estate as it relates to those of you who want to build income with flipping properties or wholesaling properties, or those of you who want to build wealth with single-family real estates
1 minute.
by lending your money to real estate investors or to homeowners through owner finance, or becoming a buy and hold landlord. My favorite all four of those is being a landlord. But you can make money and build wealth with all four of those strategies. Those are the only four ways to make money in real estate. In fact, it's the same way in commercial real estate. There's really only four ways to make money in real estate. Everything else is a derivative of those four. We spend the entire weekend, 3 days,
seconds.
Friday, Saturday, Sunday, on explaining how all those things work. If you want more information on the weekend retreat, send an email to support
20 seconds.
at Right Path Real Estate. That's support at Right Path Real Estate, and we get you signed up there. Our next free event is Tuesday. We're going to have a webinar Tuesday night and a free 1 hour workshop
seconds.
on Thursday. Go to Right Path Real Estate. You can sign up there. And I'll see you at the next event. Thanks for listening, guys. I'll see you all Monday.
All right, Mr. Bible, have a good one.
All right. Thank you.
You're welcome. Bye.
Bye.
You've been listening to Right Path Real Estate Radio. Find Jason and Tom at Right Path Real